Welcome back to the Daily Crypto Roundup. It's Friday, October 31st, 2025, and the crypto markets are finally breathing a little easier after a volatile week that saw traders whipsawed between macro headlines and on-chain optimism. Bitcoin has clawed its way back above $109,000. Ethereum has steadied just below 4,000, and several analysts are hinting that this consolidation could set the stage for a powerful November rebound. Today we're diving into 5 big stories shaping the market. We'll look at how US equity jitters from the artificial intelligence sector temporarily rattled crypto, why Tether's $10 billion profit signals deeper institutional confidence, what on-chain analysts are warning about the next possible correction, and how Bitcoin and XRP managed to turn a brutal October into a surprisingly resilient close. Finally, we'll end with a forward look. Why some of the same macro patterns we saw in 2021 might be setting up again, and what that could mean for the months ahead. Before we jump in, take a second to follow the podcast and leave a 5-star rating if you haven't already. It helps new listeners find us, and lets us keep covering the stories that actually move the market, not just the headlines that grab attention. Alright, let's start where we always do. The top 10 coins and the pulse of the market. Bitcoin sits just above $109,000. Up about 1% on the day. Ethereum trades near 3,800, still locked in a tight range but holding firm above major support. Solana continues to show strength, holding around 185. XRP is at $2.50, while Cardano sits near 60 cents after a small uptick overnight. Dogecoin holds at 18 cents. Binance Coin stands strong around 1,079. Avalanche trades just below $18. Chainlink is around 17, and Stellar Lumens rounds out the list at 30 cents. Together, those 10 assets account for nearly 3/4 of the entire crypto market cap, which remains close to $3.7 trillion. Dominance remains stable at 57% for Bitcoin, meaning capital is still favoring the blue-chip assets while the market rebuilds confidence. Now, let's get into today's main stories. First up, the macro shadow that's been hanging over markets this week. Despite today's rebound, investors spent most of the week watching traditional equities rather than blockchains. The sell-off in major US tech stocks, triggered by warnings about slowing artificial intelligence spending, briefly spilled into crypto. When mega-cap names like Nvidia and Microsoft wobble, risk assets everywhere tend to feel it. But here's the nuance analysts are pointing out. Crypto didn't fall as hard as it used to. In previous years, a Nasdaq slump would send Bitcoin tumbling 10% in hours. This time, it was a brief 2% dip, followed by quick recovery. That relative resilience is quietly boosting confidence among long-term holders. Several on-chain researchers, including data analysts from CryptoQuant and Glassnode, note that realized volatility has dropped to its lowest point in 6 months. In plain terms, even when equities panic, Bitcoin now behaves more like a macro asset with strong base demand rather than a pure speculative play. Analysts at JP Morgan echoed this sentiment, writing that Bitcoin's new ETF inflows have stabilized its price action and given institutions a predictable way to accumulate exposure without driving wild swings. So while mainstream headlines painted the market as down, those inside the space saw something very different: a maturing asset class starting to decouple from stock market noise. Now, a quick word from our sponsor. In a market that changes faster than headlines, the one thing you can control is how you secure your crypto. Ledger hardware wallets keep your Bitcoin, Ethereum, and other assets safe, offline, under your control, beyond the reach of hackers or exchange failures. You can find the link in the description. Protect your wealth before the next move begins. Another big headline today was Tether's record-breaking $10 billion profit. Tether, the company behind the world's largest stablecoin, quietly published financials showing more than $10 billion in annual net profit, driven largely by yield from US Treasury holdings. The numbers are staggering. Tether now holds over $135 billion in assets, including roughly $100 billion in short-term US government debt, around $5 billion in physical gold, and an estimated $3 billion in Bitcoin. Now you might be asking yourself, why does this matter? Because Tether's profitability and transparency are central to crypto's overall liquidity health. Stablecoins like USDT act as the lifeblood of trading volume across almost every exchange. When Tether earns record profits, it means the ecosystem's most used dollar proxy is solvent, sustainable, and reinvesting in infrastructure. Market strategists at Kaiko said Tether's dominance now exceeds 70% of the stablecoin market, and its treasury holdings alone rival the reserves of mid-sized national banks. It's a stunning shift. What started as a controversial dollar-backed token is now effectively one of the world's largest shadow financial institutions. There are critics, of course. Some regulators worry that the concentration of treasury debt in private hands could pose systemic risk. But for now, traders are viewing Tether's success as a signal of crypto's growing integration with traditional finance. The company's balance sheet stability acts like an invisible anchor, keeping liquidity flowing even when macro volatility spikes. Next, on-chain analysts are spotting early warning signs of a potential correction. Despite the upbeat tone in prices today, some researchers are urging caution. Data from Sentiment shows that funding rates across major derivatives exchanges have started creeping higher again, indicating that leverage is building back up after being flushed out earlier in the month. Historically, that pattern tends to precede short-term pullbacks. However, this is where the nuance matters. Analysts emphasize that what we're seeing isn't a sign of imminent collapse. It's a normal reheating of the market after a cooldown. In past cycles, similar setups have led to brief 10 to 15% dips followed by renewed uptrends. Look back to 2021. Bitcoin consolidated around 60,000 for weeks. Leverage built up, funding turned positive, and a small flush reset the market before the parabolic run to 69,000. CryptoQuant's head of research noted that whale inflows remain low, meaning large holders aren't dumping supply. Meanwhile, exchange reserves continue to fall, suggesting most of the selling pressure has already passed. So even if we do see a short-term correction, it's more likely to be mechanical rather than panic-driven. Story 4. Bitcoin and XRP closing one of the toughest Octobers since 2018 with unexpected resilience. October has historically been known as Uptober in crypto circles, but this year it tested that nickname. Bitcoin fell as much as 15% mid-month before rebounding strongly into the 109,000 zone. XRP followed a similar path, dropping to the low 240s before reclaiming 250. Market historians point out that the pattern resembles the late stages of the 2017 cycle. Strong macro headwinds caused temporary fear, followed by aggressive recovery fueled by long-term conviction. Analysts at Bernstein recently projected that Bitcoin could retest 125,000 by year-end if institutional inflows continue at current pace. XRP, meanwhile, continues to attract speculative attention ahead of possible new ETF products and global payments partnerships. The key takeaway? Every major dip this year has been bought up faster than the one before it. That suggests capital rotation rather than flight. A market redistributing, not collapsing. And finally, a quick look at the warning flashing beneath the surface. Macro crosscurrents between inflation expectations, bond yields, and crypto correlation. Even though today's prices are green, many analysts believe we're in the calm before another liquidity squeeze. The Federal Reserve's hawkish tone earlier this week briefly rattled both stocks and crypto, and while Powell avoided direct mention of digital assets, traders read between the lines. Higher yields mean tighter liquidity, and crypto, being a liquidity-sensitive asset class, always feels that pressure first. But here's where sentiment splits. Some macro strategists argue that if inflation continues to cool, the Fed will have room to ease by the first quarter of 2026. That easing could unlock a flood of sidelined institutional cash waiting for clarity. Others, like analysts at Fidelity Digital Assets, believe the resilience of Bitcoin above 100,000 already signals that the market has priced in the worst. Historically, when macro stress peaks, Bitcoin bottoms aren't far behind. In 2020, during the COVID crash, Bitcoin lost 50% in a single month, then tripled within 90 days once the Fed pivoted. In 2022, after the FTX collapse, it took roughly 4 months for the market to recover, and those who accumulated near the lows saw 5 to 6 times returns within 18 months. The lesson is simple. Fear usually precedes opportunity. Today's headlines may sound cautious, but behind the noise, structural adoption continues. Stablecoin supply is rising, ETFs keep absorbing supply, and long-term holders remain unshaken. As we wrap up today's roundup, it's worth remembering how crypto tends to behave at the tail end of volatile years. The fourth quarter often acts as a reset. Short-term traders exit, leverage fades, and strong hands consolidate. That base sets the foundation for the next wave. If 2026 begins with even modest monetary easing, we could see history rhyme once again. Bitcoin's consolidation above 100,000 echoes the early stages of previous megacycles. Ethereum's ecosystem continues expanding beneath the surface, from roll-ups to restaking. And altcoins like Solana and Cardano are quietly proving that innovation hasn't slowed. It's just gone quieter while the noise fades. For the average investor, that means patience. The next major leg up doesn't come from hype, it comes from conviction built during quiet markets. Every week we cover stories that feel disconnected. Stablecoin profits, regulatory hearings, exchange listings. But together, they form the architecture of the next bull run. So don't let today's cautious headlines fool you. Beneath them is the same story that's always driven this space: innovation, volatility, and resilience. And as always, drop your thoughts in the comments, follow the podcast, leave that 5-star rating, and we will see you at the top.